The thought of buying a home in your 20s can feel like fitting a square peg in a round hole for many. An impossible feat with rising housing prices, high interest rates, limited inventory, and needing to submit an offer for hundreds of thousands of dollars over asking price just to get your offer accepted. Well, in this video, I'll show you exactly how you can buy your first property without submitting an offer for hundreds of thousands of dollars over asking. We'll start with getting ready to enter the market to then getting your offer accepted to then closing, all while not making the stupid mistakes of submitting that offer for tens of thousands of dollars above asking price and waiving all inspections and contingencies. All you have to do is go ahead and hit that subscribe button and we'll go ahead and get started. So who am I to give advice on this topic anyway? I am a licensed real estate agent in New Hampshire and Mass. The last transaction I recently closed was for buyers in their early 20s with minimal money down. Their offer required an inspection, was the first offer they ever submitted, and also 2 of the last 3 transactions were all for buyers in their 20s, and they didn't pay over asking on any of them. None of them waived inspections. I also own $1.5 million in real estate, and I'm on track to own $10 million in real estate by the age of 28. But that's not why you clicked on this video. So let's talk about how you, someone in their 20s, can buy their first home. Preparation before entering the market is crucial. There's a saying out there by Abraham Lincoln that goes, "Give me 6 hours to chop down a tree and I'll spend the first 4 sharpening my axe." We're going to do exactly that. We're going to start off by sharpening our axe to make sure you are as qualified as possible as a buyer. And I don't mean having millions of dollars in the bank. I mean your credit score, source of income, and having the funds in your bank to simply close on the property. The first important factor is having a good credit score. The best credit score for most favorable lending terms is a 740. If you are below this, then the best thing to do would be to obviously improve your credit to make sure you're getting the best terms. But how do you do this? There are a few key factors that impact your credit score. Length of credit, different types of credit, credit utilization, and the ability to pay back credit lines on time are all key factors that influence your credit score. Payment history is crucial for obvious reasons. The longer you go proving that you can pay what you spent on time, the more trustworthy you are as a borrower. Credit bureaus like to see at least 18 months to 2 years of consistent on-time payments. Payment history accounts for about 35% of the credit score weight and will be a big driving factor in getting you that mid to high 700 credit score. The credit reporting bureaus also like to see different types of credit lines. Some examples of different credit lines would be a car loan, a home loan, a credit card, a personal loan, things like these. This credit mix only accounts for about 10% of your credit weight, however, so don't go out and open up all these different lines of credit at once, as it will actually negatively impact your score. This will negatively impact your score because credit bureaus also look at how many credit inquiries you make at a given time. If you're shooting for a good credit mix, a good rule of thumb would be to space out these inquiries a few months and really only open them if you absolutely need them. Opening credit card lines are crucial, but only apply for auto and personal loans and things like this if absolutely necessary. Additionally, your credit score is impacted by credit utilization. Credit utilization is how much of your given credit line you are using at a given time. So say you have a credit line on your credit card of $10,000. You should spend no more than $3,000 before paying it off. Credit bureaus and lenders like to see that you don't use more than 30% of your credit at a given time. The best way to go about credit cards is to treat them like a debit card. Only spend the money you have and then pay it off every week. Or as soon as you spend it, you could also pay it off at that point in time as well. This will ultimately make sure that you keep that credit utilization low. If you're interested in more in-depth tips on this topic, I'll link to the video Why Your Credit Sucks in the description. That video will go more into the weeds of credit and how to improve your said credit score. All right, now that we have worked to improve that credit score, it's important to get your income right. Qualifying for a home with your primary income source, you have either a W-2 employee or you're self-employed. With a W-2 job, you need to work for at least 2 years and need to provide 2 of the most recent pay stubs when qualifying for that home. If you went to college college, then right into employment, then lenders can generally use that time in college towards the 2-year qualifier. But if you're self-employed, well, then the lender will require at least 2 years of tax returns to qualify you. And this is tricky for 2 reasons. One, because you need to show consistent income for those 2 most recent years. Lenders don't want to see you made $180,000 one year, but then the next you only made 80. And 2 is because you can't write off all your income down to 0, which most self-employed individuals tend to do. Now, this doesn't mean you shouldn't be self-employed. It just means if you're planning on buying real estate and using a loan to do so, then make sure you claim a good chunk of that money to show your lender that you make a wage to base your qualification off of. Lenders also want to see that you have funds set aside for closing. This is fully dependent on how much you plan to put down on the house. So if you're going to do the 3.5% FHA route, then set aside that plus an additional 3% for closing costs and miscellaneous fees just to be safe. If you're going the 20% conventional route, then make sure you have that 20% set aside plus an additional 3% for any closing and miscellaneous fees. Lenders need your funds to be sitting in your bank account for at least 60 days before they can use them for the loan. I believe this is to make sure that the funds are not fraudulent or laundered, but I'm not 100% sure on that one. Okay, we've sharpened our axe. You have a great W-2 income, a 740 credit score, seasoned funds that are ready to go. Now what? Well, now it's time to find a good real estate agent. And I know I might lose some of you here, but I really can't vouch for this enough. Having a great agent will save you tens of thousands of dollars in the long run. So do a Google search of agents in your area that have closed a lot of deals and have great reviews. I recommend this over going with your mom's best friend from high school that has her real estate license, unless you search her up on Google and she has closed a lot of homes and has great reviews. I only say this because everyone knows a real estate agent these days, but not all agents are created equal. So make sure you pick an agent that actually knows what they're doing and can be an asset in helping you manage one of the biggest purchases of your lifetime. There are over 85 variables in the home buying process that need to be perfectly executed on the buyer's side and over 115 variables on the selling side. So pick someone that does this for a living and knows what they're doing, or else it can be a costly mistake for you as the buyer. And that's all I'm going to say on this point. Okay, we're ready financially and now have an agent. Now it's time to get in touch with a lender to get you pre-qualified. A pre-qual letter will tell you exactly what you can spend based off your income, savings, interest rates, the approximate taxes, and insurance for the area that you're looking in. This will give you a solid idea of what your budget is. Now that you have that, it's time to go shopping. All right, now we've entered the market, and let's just say we find a home that meets exactly what we want. It's within our budget and it's our dream home, but there's other people that are also bidding on it and is also their dream home. They now have a multiple offer situation. So how do we put your offer ahead of the competition and give you the absolute best chance of getting it accepted? Well, there are a few ways, some of which involve being an absolute pain in the butt to the listing agent in the best way possible. What makes a strong offer to a seller is completely dependent on the given seller. This is important to unveil before even submitting an offer. Inquire about why the seller is selling, what the ideal offer is, what it would take to make a deal happen, and what they're looking for in a buyer. There are a lot of different types of sellers, but I've seen 2 pretty prominent types. There's a seller that their home is an extension of them and they want the next buyer to take the best care of it and maybe raise a family and cherish it as they have. Or there's the seller that wants to get the absolute maximum amount for their house and doesn't care as much about who they're selling to or what the buyer intends to do with the actual place. These are 2 very different sellers and would likely consider 2 very different offers. The seller that wants someone to cherish their home might be willing to accept less for their home if it meant someone is going to cherish it, versus the seller that wants to get the absolute most might be more interested in the buyer that is willing to spend a little bit more for the house. So how do you give yourself the best chance of getting your offer accepted? Well, for the first seller, it might be a good idea to write a Dear Seller letter where you touch upon how you want to cherish the home or how you will cherish the home and maybe raise a family in it. Versus the second seller, you might have to increase your offer price to give them a little bit more for the house. Now, it's absolutely imperative that the baseline of your offer does not stray away from the fundamentals unless absolutely necessary. What I mean by this is if your seller asks you to submit an offer above comps or include gap coverage on your offer or waive inspections or anything else of this nature, then you need to understand that this is a risk. It can absolutely be an expensive risk, and you should work with your agent to properly assess if it's a risk even worth taking. Sometimes, if this is what the seller wants and they won't budge on this, then it's a good idea to walk away. There will be other houses in the future and it's okay to walk away. Walking away in these situations, if the risk doesn't make sense, can save you a lot of money. Sorry for the tangent, but I see first-time homebuyers in this market do this more times than not. They'll put in an offer for $50,000 over asking, waiving inspections and contingencies on a house that is beat, not knowing that the home will cost a lot more just than the cost to acquire. Do not let this be you unless you understand what you're getting into. Okay, but how do you give yourself the best chances? Well, you want to inquire about what the seller wants and give them that within reason. Have your lender call the listing agent and vouch for your financial strength and ability to close. Send the seller the Dear Seller letter that we talked about. Have your real estate agent in consistent contact with the listing agent so the listing agent has your offer top of mind. Make sure your offer is as reasonable and best that you can do based on the comps and what your agent advises. Ask the question of where do we need to be to make this deal happen? This will get the seller thinking about your offer and where you would need to be to get a deal done. Increase your earnest money deposit. This is the equivalent of a good faith deposit and comes off the amount of money you're ultimately going to be putting down. But the more money you put down in earnest money deposit, the more serious you look as a buyer. Sometimes sellers just want a quick close. So find out if that's what your seller wants and then work with your lender to see what you would need to do to get the loan closed as quickly as possible. These are all ways that you can increase your chances of getting your offer accepted. Once you go under contract, then you enter a due diligence period, which is where you get your financing application completed and all the inspections done. During this period, if you find something that you don't like that makes you no longer want the deal, then you can pull out and get your earnest money back. You will be out the cost of the inspections in this instance, but if you find out the roof needs to be replaced in the coming months and the sellers aren't willing to negotiate to a price that would reflect that, then it might be smart to take that $800 loss on the inspection and prevent going through the closing to then pay for an additional $30,000 roof shortly after the due diligence period. What comes next is going to be outlined in your actual purchase and sale. This is basically a timeline of when you need to have everything in good order to keep the transaction moving and on track. Your agent will also help in this matter to make sure everything runs smoothly and that you meet all the appropriate timelines on time. Closing is basically a bunch of signing, and then you get the keys for your new home and you are now a homeowner. You get to move in that day, paint, make the place your own, whatever you want. I hope you enjoyed this video. Make sure you go ahead and hit that subscribe button, drop a comment, and check out one of my other videos here.